Noir Plasma Chrome Bleed. Unlocking knowledge, inspiring innovation, empowering curious minds.
This website makes learning so easy. I found all my resources here.
Like what you share.
Right, let's jump straight into this explainer. Today, we're going to completely demystify what can feel like a totally intimidating architecture, Indian direct tax law. We're taking a journey from the bedrock legal doctrines all the way up to those notoriously complex CA final stress tests. So if you've ever felt completely overwhelmed by the sheer volume of tax provisions out there, you are exactly in the right place.
Here's a quick look at our roadmap. We'll kick things off with the foundations of direct tax, then pivot into cross-border and international tax. After that, we'll unpack transfer pricing and anti-avoidance, stress test it all with some CA final case studies, and finally, look ahead at the future global tax trajectory.
All right, Section 1, Foundations of Direct Tax, Building the Jurisprudential Architecture.
To really understand the massive Income Tax Act, you have to see how it's held up by a crazy interplay of legislation, judicial precedent, and academic commentary. Take a look at this grid of foundational literature. It's fascinating. You've got canonical texts like Conga and Palkavala that absolutely demand strict, literal interpretation. Basically, there's zero room for equity or intention in a taxing statute. You just read exactly what's on the page. But then, contrast that with modern works by folks like Dr. Singhania or Dr. Ahuja and Dr. Gupta. They give us the standardized, highly algorithmic structures we actually need for corporate compliance today. It's this incredible evolution from pure abstract constitutional theory down to gritty, practical execution. And that brings us to the classic judicial dividing line. Now, tax planning? That's just using legitimate exemptions. Totally fine. Tax evasion? That is outright fraud, which we, of course, absolutely do not recommend. But the real friction is in that gray area in the middle. Tax avoidance. This is where you structure things completely legally, but purely to defeat the intent of the law. Enter the General Anti-Avoidance Rule, or GAR. GAR was a massive game changer. It literally empowered tax authorities to strike down arrangements that look flawless on paper but lack any real commercial substance.
Moving right along to Section 2, Cross-Border and International Tax, Navigating Global Frameworks.
We've got to start with SEP, which stands for Significant Economic Presence. Just think about your absolute favorite global cloud software or digital platform. Historically, for India to tax a foreign company, that company needed a physical office right here. But SEP changed the whole shebang. It's the statutory framework specifically designed to tax digital enterprise models that operate without a single brick of physical infrastructure in the country.
So how do you actually trigger this? Well, you hit SEP if your transaction revenue exceeds 2 crores rupees, or, and this is a big or, if you have user interactions with 300,000 active users in India. The absolutely crucial takeaway here is that hitting either of these two highly specific numerical thresholds instantly establishes a statutory business connection under domestic law. Literally, your physical location doesn't matter anymore. But, domestic law is only half the story. Under international treaties, a source state's taxing rights rely on what's called a permanent establishment, or PE. And historically, a PE meant you needed a fixed place, a construction site, a service PE, or a dependent agent. Do you see the friction here? These are all deeply rooted in a physical or direct agency presence, and that crashes head-on into those strictly digital SEP rules we were just talking about. Let's zoom in even further. Section 3, Transfer Pricing and Anti-Avoidance, Protecting the Tax Base. Imagine a transfer pricing adjustment gets made to bring a transaction to an arm's-length price. What actually happens to the cash? Under Rule 10CB, if that primary adjustment is over 1 crore rupees, it's not just some harmless paper entry. That excess money has to actually flow back to India.
physically, within a strict 90-day window. If it doesn't, the law deems it an interest-bearing loan to the foreign entity, which triggers a never-ending cycle of perpetual notional interest. Talk about a compliance nightmare.
Now, to escape that endless interest imputation and all the headaches that come with it, taxpayers are given a very specific out. You could opt for an effective settlement tax rate of exactly 20.9664%. If you pay this one-time, hyper-specific additional tax, you are completely discharged from any further secondary adjustments on that money. It's essentially the price of peace of mind.
And all of this ties perfectly into the macro global picture. India has been incredibly aggressive in adopting global base erosion and profit shifting, or BEPS rules. For instance, Section 94B caps interest deductions to foreign entities at 30% of EBITDA. Then you have mandatory three-tier transfer pricing documentation. And, of course, the equalization levy to tax e-commerce. It is a very tight, very deliberate net designed to relentlessly protect the tax base.
All right, Section 4. We've tackled the theory, so let's get our hands dirty. CA final case studies, stress testing the architecture. Let's look at our first scenario. A U.S. associated enterprise fails to repatriate a 2.50 crore adjustment. So how exactly do you compute the notional interest? Well, because the transaction is in foreign currency, you can't just use some standard domestic rate. You actually have to use a 6-month LIBOR or SOFR rate plus a 3% spread. It is a textbook example of how massive international macro finance directly dictates your micro everyday tax computations.
Moving to case 2, we have a classic digital economy dilemma. This brilliantly shows off the treaty override principle in 3 simple steps. Step 1, domestic law triggers SEP because, let's say, they have a massive user base and high revenue. Step 2, but wait, under the India-US treaty, they don't have a physical PE. So, step 3, we apply the Section 92 override. This means the treaty benefits completely prevail. The final result? Zero Indian tax liability for the foreign cloud provider, even though they easily blew past the domestic SEP thresholds. Pretty wild, right?
Case 3 dives into domestic presumptive taxation. We've mapped out 4 unique scenarios here, but I want to highlight something really surprising about one of them, Mr. Arjun. Now, Arjun has a 2.40 crore wholesale turnover, but because it is 100% digital, he actually qualifies for an enhanced threshold. That completely electronic footprint literally saves him from a mandatory tax audit as long as he declares a 6% presumptive profit. It perfectly illustrates how heavily the law incentivizes a fully digitized economy.
Now, case 4 looks at restructuring a business via a slump sale. The workflow here is absolutely critical. When you're determining net worth to calculate capital gains, asset valuation is everything. Depreciable assets, you use the written down value. Non-depreciable, you use book value. But here's the kicker. Any past asset revaluations are strictly 100% ignored. On top of that, indexation benefits are completely barred by law. It is a very rigid, totally unforgiving calculation.
For our last practical test, Case 5 features a foreign entity earning fees for technical services, royalty, and dividend income in India. This matrix right here is proof of the immense power of a double taxation avoidance agreement. By opting for the treaty rates, those heavy 20% domestic rates get slashed to a flat 10% cap. And it gets better. Not only does this have the withholding tax, but under Indian law, if the tax is fully deducted at these treaty rates, the non-resident is actually exempt from even having to file an Indian tax return. It's a massive relief.
Okay, let's pan all the way back out for our final section, Future Global Tax Trajectory, the Road Ahead.
We are currently witnessing a monumental shift in global economics. On one side, we have BEPS Pillar 1. This is rapidly expanding source state taxation rights, reallocating profit directly to market jurisdictions, even if there's no physical presence. Sounds a lot like India's domestic SEP rules, doesn't it? On the other side, Pillar 2 enforces a firm 15% global minimum corporate tax rate. This is explicitly designed to kill off low tax havens once and for all and stop the international race to the bottom.
And that leaves us with a genuinely fascinating question to ponder as we wrap up this explainer. As these massive multilateral treaties like Pillar 1 expand and domestic rules seamlessly sync up with global standards, are we actually watching the slow erasure of domestic tax borders altogether? Will traditional, isolated domestic tax rules eventually become completely obsolete in a synchronized global digital economy? It's a massive shift, and understanding this architecture is your absolute key to making sure you stay ahead of it.
Like what you shared.
This website makes learning so easy. I found all my resources here.
Noir plasma chrome bleed. Unlocking knowledge, inspiring innovation, empowering curious mind.